Hello and welcome, everybody. I'm delighted to have with me Oliver Marschner today, Senior Portfolio Manager and Head of the Emerging Markets Closed-End Fund Group at City of London Investment Management. City of London Investment Management has built a strong reputation as a specialist in closed-end funds, an investment vehicle that offers unique opportunities for investors. Today, we talk about who City of London Management is, why closed-end funds are such an interesting approach, and why emerging markets are particularly compelling right now. And of course, we'll dive into the strategy of the Emerging World Fund. A warm welcome to Oliver Marschner.
Thank you, Thomas, and I appreciate the opportunity to introduce our firm.
Oliver, could you briefly introduce City of London Investment Management and its background?
Certainly. City of London Investment Management, or CLIM, C-L-I-M for short, is an asset manager founded in the early 90s, and our parent is listed on the London Stock Exchange. We currently have $6.8 billion under management, with the vast majority of our clients being US-based long-term institutional investors, and that includes foundations, endowments, and pension funds. We have offices in London, Philadelphia, and Singapore, which allows us to trade emerging markets pretty much 24/7. City of London identified pricing inefficiencies inherent in closed-end funds to access emerging markets. And over the years, the firm has expanded its strategies to include frontier, developed, opportunistic value, listed private equity, and in all cases, using the same process, taking advantage of price anomalies in closed-end funds to generate alpha.
So City of London Investment Management focuses on investments in closed-end funds. How do closed-end funds work, and what is the exact advantage of this investing approach?
Well, as the name suggests, a closed-end fund is an investment vehicle with a closed or fixed capital structure, as opposed to an open-end fund. So in the case of a closed-end fund, they issue a fixed number of shares via an IPO, and that trades publicly on a listed exchange, just like any other stock. So as they trade on an exchange, the price is set by demand, as that supply is fixed. And then similarly to open-end funds, a closed-end fund issues a daily net asset value, so an NAV, the value of the underlying investments. And the important thing for us is that shares in closed-end funds trade at either a premium or a discount to that net asset value. And that really is what we look to exploit. So the premium and discount can be volatile over time, and we look to take advantage of that price change relative to the net asset value by buying into funds when their discounts are wide relative to their history, and then selling as the discount narrows, capturing alpha in that manner.
How does City of London Investment Management's investment process work when selecting and analyzing underlying closed-end funds?
We use a top-down macro framework combined with a bottom-up fund selection. So the top-down allocation is run by our macro team, which is a 3-person strong team based here in London. And they formally rank the 27 emerging markets on a quarterly basis. So they look at the markets on a 9 to 12-month time horizon, suggesting which countries we should be over and underweight. And then the portfolio management team, they re-rank the macro team recommendations and decide how best to achieve their target allocation based on the discount value available in the closed-end funds. So from a bottom-up perspective, we are seeking closed-end funds that we believe are well managed and then buying them at the widest possible discount. It's important to get the countries right, but it's equally important to find managers who are going to outperform or at least perform in line with the index after fees in NAV terms. So if a manager is able to perform in line with the with the benchmark, we are able to add alpha by buying these funds on wide discounts and then recirculating out of the funds into discount narrowing. So the process is quite simple. We're looking for countries that will outperform, accessing them via good managers, and then buying these closed-end funds when they are trading as cheaply as possible.
So let's move on to the strategy, the Emerging World Fund. Why do you currently consider emerging markets to be an attractive investment?
Emerging markets have been highlighted as good value for some time, but have unfortunately lacked a catalyst. And we've seen really 10 years of underperformance of emerging markets versus most other asset classes. Various economic and macro narratives are now starting to line up in favor of emerging markets. So we are quite positive on the asset class. The US dollar is weakening and the Fed is cutting rates, both of which have historically been favorable for emerging assets. And then also, emerging markets have a very significant exposure to AI, which is obviously the current large growth area in global markets. It's estimated that between 40 and 45% of the MSCI emerging index is tied to AI through major tech and semiconductor firms. So if you look at the top five index constituents, which is very much similar on our portfolio, we have TSMC, which is the world's largest semiconductor foundry, producing chips for Nvidia, Apple, Broadcom, etc. Then Tencent, the Chinese gaming and cloud company, Alibaba, the Chinese e-commerce and cloud computing giant, and then in position 4 and 5 in the benchmark, it's the Korean companies Samsung Electronics and SK Hynix, both of them with very large exposure to AI via their hardware and semiconductor production. So sentiment is finally moving in favor of emerging markets at a point when valuations still remain cheap. And therefore, we are very positive on the space.
A lot of relative names from the tech industry that you mentioned. So what exactly are the main advantages of combining and investing in emerging markets via closed-end funds?
So, using a disciplined institutional approach to investing in an asset class that is predominantly dominated by retail investors has enabled us to establish a long track record of outperformance. Retail investors tend to be less sophisticated and are less aware of what the discount is at any point in time. We have a massive research focus on the net asset values of these funds and then compare that on a live basis to prices. And so we spend a lot of time focusing on the discount, and our database has the discount history of all of these closed-end funds going back to their inception. So when competing in a very retail-dominated space, we definitely have the upper hand with regard to our technology and real focus. Separate to that, closed-end funds are generally well managed by well-known institutional managers such as JP Morgan, Fidelity, Schroders, Aberdeen. They all offer these closed-end funds, and they have large teams focusing on the specific regions, sectors, or countries that we are investing in. So aside from the expertise this provides, it also ensures strong governance, and that obviously is very important when investing in emerging markets. And importantly, once again, we are buying these funds at a discount to the net asset value. So we're buying Tencent and Alibaba managed via Fidelity and JP Morgan, but at a 10% plus discount to that value. We also believe the closed-end fund as a investment vehicle is a superior investment option. And I say that as the closed-end fund wrapper is a benefit to the manager. So the fixed structure allows the asset manager to really focus on a longer term investment time horizon. If you can imagine, an open-end fund manager needs to keep a certain amount of cash on the side for any potential large inflows or outflows. A closed-end fund manager can focus down the cap scale and really focus on the full market cap spectrum, which will allows them to invest in different liquidity characteristics. Interestingly, if you compare a JP Morgan open-end fund managed by the same team as their closed-end fund, generally speaking, over time, the closed-end fund will have outperformed, and it's because of that closed structure. And then finally, closed-end funds also provide great diversification. So on average, our portfolios consist between 40 and 60 closed-end fund holdings focused on a particular region or country. And each of these closed-end funds invests in a portfolio of anywhere from 50 to 80 underlying equities in that particular market. So on a see-through basis, our portfolio provides exposure to over 3,000 underlying emerging market equities, and that results in a lower tracking area.
So you already mentioned a couple of criteria, especially discount or expertise of the underlying manager. Are there other specific factors that you're looking into when you are selecting a manager and a closed-end fund for the EWF portfolio?
The two you mentioned are the top two in terms of focus, so expertise of manager. So we obviously meet with the teams at least annually. We look at their process, their positioning. Does their performance record match up with what they're telling us their process and their positioning is? But as you say, the discount to the net asset value, that is obviously also very, very important to us. So once we're happy with the team and the manager and the fund, then the focus is on what is the current value in the investment relative to its history. And so we have the database and systems we use that track that all live, going back, as I said, to the inception of these positions. Also, very importantly, these are companies, and as they are companies, they have boards of directors. And so we are looking for boards that are shareholder friendly. Why that is important is it's the board's responsibility to look after shareholders, and that covers performance and discount. So if, for example, Fidelity China, if that over long term is underperforming its benchmark, we can put pressure on the board to fire Fidelity and then replace Fidelity with, for example, JP Morgan. So the company structure is set up in such a way that the board is an important component. And obviously, we're looking for boards that are going to be proactive. Also, discount. If the discount continues to widen, we can put pressure on the boards to address that so they can have a tender offer or buybacks or ultimately liquidate the fund. In each case, assets are returned to shareholders at net asset value, which again is an attractive proposition because we're buying into these positions at large discounts. And then finally, the other consideration is liquidity and trading volume. We are in a space that has a limited capacity, which is why you don't have the large asset managers competing with us. So JP Morgan and Fidelity, they would much rather manage the closed-end fund than actually be investing in the space. And that is another advantage for us. We're small and nimble and can take advantage of this dislocation. But obviously, we want to be buying into funds where there's enough liquidity to be able to build a significant position. And then when discount narrows, you also want to be able to obviously sell the position and take advantage of that narrowing.
Very interesting background. So the emerging world fund has a different return profile than traditional emerging market funds. So what does that look like, and how do you generate alpha?
Yes, being a closed-end fund strategy, there's a differentiated and complementary source of alpha. The majority of the alpha generated on the emerging world fund is from that discount capture and buying undervalued closed-end funds and then benefiting from discount narrowing. And this is obviously very different from most other managers who will have a style or a sector bias, and then will, as a result, they'll perform well in a certain market cycle. So, for example, if you've got a growth or a value tilt, or if you have a large exposure to mega caps or small caps, whereas we don't really rely on a specific market cycle. We are really just continually trading the discount and the value in these funds. So we'll be selling an India fund listed in London and moving it into an India fund listed in New York. And at the end of the day, still having the same underlying exposure, roughly speaking, but trading that discount, just moving from where we see less value into something that's offering greater value. And the strategy is well tested. We've consistently generated alpha via discount trading since its inception over 33 years ago. We've delivered superior returns versus the MSCI benchmark of over 200 basis points per annum, with a relatively low tracking error. So it definitely is a niche area where a great hunting space for us.
Emerging markets are considered volatile. So how does City of London Investment Management deal with the explicit risk associated with emerging markets?
Emerging markets certainly come with some additional volatility, but that also creates opportunities with a good framework. So we've got this dedicated macro team, as I mentioned, and they follow a very disciplined approach of identifying attractive country opportunities and then avoiding the areas which are looking less stable or less compelling. So this research follows a scorecard approach, and that's based on three key pillars. So they look at the macroeconomic fundamentals, market fundamentals, and political criteria of each of the emerging markets. And then we can rank our country preferences and focus on buying closed-end funds where we see compelling return potential while also limiting exposure to value traps.
Lately, we've seen the US dollar coming down in valuation, which is vitally important for emerging markets, obviously. So what role does currency, for example, hard versus local currency, play in your portfolio and your investment decisions?
The currency consideration that takes place at the country ranking stage, so in the top-down asset allocation. So the macro team considers the return prospects for the local equity market and also the currency. So in effect, they are making a recommendation based on the expected total return. And so obviously in some highly cyclical markets, the FX returns can be a significant component. And thus it's vitally important to look at the total return profile when determining which countries we should be overweighting or underweighting.
So this was Oliver Marschner from City of London Investment Management. Oliver, thank you very much for sharing your perspectives on the City of London Investment Management, closed-end funds, and the opportunities in emerging markets.
Thank you, Thomas.